One of the worst performing REITs in the market this year is Alexandria Real Estate Equity, stock ticker ARE, which is now down over 51.1% in the last year. And they just saw a large sell-off after releasing their latest quarter's earnings report, down about 23.5% in the last month. And trading at this price now gives them a starting dividend yield right at 9.5%. So there's a lot of news we need to cover, so let's go ahead and dive into it. Now, if you've been following the channel for a while, you already know that REITs are dramatically undervalued compared to how they've historically traded, and especially compared to US equities. And a large part of the bull run that we've seen from the S&P 500 right now is because of more firms integrating AI. Now, while REITs aren't as much of a direct beneficiary from artificial intelligence, they also aren't necessarily threatened by it as much. AI can do things like generate code, designs, and even strategy, but it can't generate new downtown land. REITs have what we would call irreplaceable assets. And in the case of Alexandria Real Estate Equities, they're even more niche. Alexandria Real Estate actually owns, operates, develops, and acquires, sometimes even redevelops real estate that is specifically tailored to the life science/biotech sector. Basically, they build these massive collaborative mega campus ecosystems in key innovation clusters. What does that mean? Well, it's basically the idea that life science companies gain advantages being co-located with academic institutions and other biotech firms, also talent and capital. So this is a very specific type of REIT that we're talking about. However, in the last couple of years, they have faced a massive problem. The life science space has become oversupplied, and it's led to two things: declining rents and higher vacancy rates. And so with those two things combined, it's not difficult to see why we've seen such a sell-off in the last year. But here's what's become interesting about this stock. If we look at the historical valuation, now again, we're looking at REITs, so we want to pay attention to the price to AFFO multiple. Right now, the P to AFFO multiple is 7.59. Well, compare that to their sector, how they've historically traded. It's about 50% lower on average, and it's also around 50% lower than the historical average multiple for ARE. So some investors seem to be of the belief that this is a unique opportunity. I see a lot of buy ratings on Seeking Alpha. And to be fair, historically, the fundamentals of this REIT have grown at a pretty healthy rate. If we look at the 2024 annual report, we can see one of the things they tout is a very healthy growing dividend. And at this time, the 2024 Q4 payout ratio was only sitting at 55%. But in this recent earnings report, we had some news that I don't think anyone was expecting. It was quite a bit worse than what the company was projecting, so let's go ahead and dive into these results. Now, to start off, we can see the company missed on top and bottom lines. That's not a good start, but it does get a bit worse. Q3 FFO of 2.22 was a miss by 9 cents, and revenue of about $751 million was down 5% year over year, missing expectations by about 2.41%. But now let's get into what really hurts, in my opinion. If we scroll down, we can see it now sees fiscal year 2025 AFFO per share at $9.01 at the midpoint, range of about $8.98 to $9.04, which is down from 9.26 in the prior outlook. So they had to reduce their guidance. Now, for reference, over on dividendology.com, there's a link in the description. I have what I call the Dividendology database, and one of the things that I track is a database full of REITs. So let's just take a look at ARE here for a moment. And let's look at the historic AFFO per share for this REIT. We'll go ahead and zoom in just a little bit, and we can see ARE right here. Now, let's zoom in. We can see, historically speaking, this has been growing at a fairly healthy rate, but something has changed in the last few years. Yes, number one, they did just have to lower their guidance. But take a look at what the projected AFFO per share looks like moving forward. This is what it was in 2024. We know they just lowered 2025 guidance recently, so projections will probably be going down, and it doesn't get much better in the next few years. This is what's scaring off a lot of investors right now. In the last month, there's now a higher level of uncertainty, and the projections aren't looking too optimistic. Now, what they did is they noted a couple of the primary drivers of their reduced outlook. To start, we're talking about a 1% reduction in projected 2025 same property net operating income and a 0.9% reduction in our projected operating occupancy percentage in North America as of December 31st. And this is primarily due to slower than anticipated releasing of expiring spaces and lease up of vacancy in our operating portfolio, reflecting reduced demand across the life science industry. This is the underlying theme right here, and probably the biggest concern. On top of this, we can see a reduction in projected 2025 realized gains on non-real estate investments. Now, one of the things that has me concerned as well is how this has impacted the company's leverage. When it comes to net debt, and preferred stock adjusted EBITDA, their typical target range is about 5.2x, and as a general rule, I think it's ideal when a REIT is 5.5 or below. But you can see they're now expecting this to be in the range of 5.5x to about 6x, a little more leverage than I typically like to see. And so as a result of all of this, if we actually look at some of the statements that management made in the recent earnings report, look right here, the key statement in my opinion. They stated, "We anticipate that our board of directors will carefully evaluate future dividend levels accordingly." Now, it's a little bit of a vague statement, but it's not what you want to see if you own this stock. So how sustainable is this dividend actually moving forward? Because one of the things we've seen is, yes, they've historically grown the dividend at a pretty healthy rate. If we look here on Seeking Alpha, really the past decade has been pretty impressive. They were able to continue growing those dividends even through 2020, which is really a rarity for most REITs. On top of this, the dividend growth is, again, pretty solid for a REIT. Look at the 3, 5, 10 year, all above 4%. This is one of those REITs where if you just glance at the dividend metrics, you would think this is a very high quality REIT, and historically speaking, it has been the case. So how can we assess the sustainability of this dividend moving forward? The share price does not look good. Obviously, it's pulled back dramatically, and we've already seen in multiple ways how the fundamentals have certainly weakened. So here's what we need to do. We can see the forward-looking dividend rate for this REIT right now is $5.28. That's the number we need to keep in mind, $5.28. Now let's jump over to ticker.com and we can see when it comes to projected adjusted funds from operations per share, estimates right now have them at about $7.33. Personally, I'd expect this to be a little bit lower. So if we're asking ourselves the question, can adjusted funds from operations cover the dividend? The short answer right now is yes, it covers it. But things are really starting to get close here in 2026 and 2027 when it comes to the dividend sustainability if these projections play out the way that analysts expect. If in 2027 they only generate about $5.55 in AFFO per share, we can see we're starting to cut it quite close, and I really wouldn't expect a lot of dividend growth moving forward because of that. Now keep in mind, this is a vague statement. They didn't say that they're going to cut the dividend, but they are considering what the future dividend policy should look like. It doesn't look like there's an immediate need for a dividend cut at least this year, but we've seen before REITs be proactive in avoiding disasters in the future. They don't want to spiral out of control where their leverage levels are getting out of control, where the payout ratio is continually increasing. That's something they probably want to try to avoid. And so here's what's so interesting if we look at this REIT from a valuation perspective. If we go ahead and jump over to the REIT valuation sheet and look at ARE, and like always, thanks to Ticker Data, all the data is going to load into my spreadsheet. You can get access to Ticker Data at the link in the description. Now, if we jump over to the dividend discount model, one of probably the better ways to value REITs, this is where things get interesting. What we're doing is looking at historically how much this REIT has been paying out in dividends and looking at historical dividend growth. And what's so interesting is if we assume that ARE never grows their dividend again, a dividend growth rate of 0%, by that logic, the stock would be worth about $62.12 per share, but the current share price is about $55.4. So that would give the stock 12% upside if they can just maintain their current dividend. So what does that tell us? Well, it tells us a couple of things. The market is essentially pricing in a dividend reduction. It's also telling us they're pricing in a level of uncertainty. They don't know what the future of those payments are actually going to look like. And based off the guidance that management gave us, it does make sense why the market would feel that way. So what is the market pricing in? Well, if we bump this to -1%, that gets us extremely close to the current share price. So again, the market is essentially pricing in a -1% reduction in the dividend every single year moving forward. So we've entered a situation where valuation certainly becomes extremely difficult. And the reason is it's difficult to project what the future cash flows of this business are actually going to look like. If they can simply just maintain that dividend, yes, there's absolutely upside, and you can see you'd be getting about a 9.5% yield, which means if the share price doesn't even move and you get that 9.5% yield, that you're already beating historic market average returns. Whether or not that case will actually play out is to be seen. Now, it is worth pointing out real quick that there was a company in a similar position just a few years ago in Simon Property Group. If we look at them in the last 5 years, this is a REIT that's up over 132%, not even including the high dividend payments that they pay out. But if we look at the last decade, they're actually down by about 4.52%. They went through nearly the exact same thing as ARE, and saw an incredible recovery, so it's absolutely possible. But part of what they had to do to actually make that happen was reduce the dividend. It put their leverage in a much better situation. It gave the company a lot more flexibility. And so while if you're holding the stock for the dividend, a dividend reduction is never a good thing. But if you're someone watching ARE on the sidelines and you're looking for an opportunity, if we do see a slight reduction in the dividend, it could position the company in a much better situation where it may become a more attractive opportunity. So for me personally right now, there's too much unpredictability surrounding ARE for me to be interested in this REIT. It's one I'll continue to watch closely. I'll keep it on my watch list, keep up with all the earnings reports and the recent news. But I'm not going to try to bottom tick a REIT that has declining fundamentals. So go ahead and let me know what you think of ARE in the comments down below if you plan on buying or selling. And again, like always, if you'd like to be able to download any of my valuation sheets and also get access to the Ticker Data add-on in Google Sheets that allows you to automatically import stock financials directly into your spreadsheet, then you can head over to tickerdata.com at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.